Valerie, there are no shortage of annuity critics. I don't know if you've noticed that or not.
I have, actually,
yes. Yes, there are no shortage, but there's simultaneously some folks on the other side that seem to rave about annuities. So in a lot of ways, I think the extremities seem to exist in the annuity realm, right? People that are very much in favor of them, people that cannot stand the idea of them. There's full-scale marketing campaigns condemning them. Serious dollars being pushed, condemning them. Companies ready and willing to help surrender your annuity, right? So I think what's really odd, though, when you really pull back, is oddly there's a shortage of people that truly understand what an annuity is and how the fees work. And maybe that's just good marketing. Maybe that just underscores America's distaste for insurance products. Maybe folks just don't care. It's some combination potentially of those. But I think it's a lot easier to blindly dislike something than it is to comprehend it.
Mm-hmm.
So
yeah, and for sure. And I would definitely say there are big advocates for it. And I think, there is a really great pitch for them.
yes,
When somebody is approached by an annuity, they usually aren't told this is an annuity. They're saying, do you want to never run out of money? Do you
right.
want to have a guaranteed income for life? Do you want to, have like a secure market return that for sure that there will never be a negative year?
Right.
So lots of, like you said, misconceptions, and it's the understanding piece that we're really trying to get to today.
Yes.
Mm-hmm.
I think that's worth examining.
Yeah.
Given how much flow is there. My name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. I think first we probably got to ask our audience just to pause and withhold any assumptions that you might have for annuities. And the reason behind that is also slightly personal on my side, because I seem to get surprised by how these things work at times. They're constantly changing, the structure of them, the different contract rates changes often considerably if you look just in the last year. So I'm going to ask that folks just withhold any assumptions they have, because an annuity is not just one thing. Now, there are some common denominators, I think, that are worth noting across the different types of annuities. I would say the first, insurance contract, right? This is a product from an insurance company. And I would also say that the second common denominator, at least from what I've seen, is the tax nature of them. So they will defer any gains, defer being the key word there, any gains that might occur within that insurance contract. Outside of that, annuity to annuity, again, this is not just some umbrella term and you're going to get the same thing at one insurance company as you'll get at another. There are different types of products and different subtypes within those products. So I'm going to give you the 4 types real quick, okay? Income annuities, multi-year guaranteed annuities, also referred to as MYGAs, variable annuities, and indexed annuities. And within those 4, we have 2 subtypes. We have immediate and deferred, at least for 3 of the 4. Okay. So you can quickly see now we have 7 different types of annuities just off of this description. Okay.
Right.
We're not even getting into all the different riders and everything else that can be involved here.
Yeah. And Mike, maybe before we jump into the types, like just the very basic, what on earth is an annuity? So like you said, insurance product, which insurance is there to help you guarantee things, right? So they'll pay out if there is for life insurance, if there's a death or an accident. With an annuity, you're giving your money to an insurance company and then they're guaranteeing to give it back to you in a certain manner. And so herein comes all the different types of ways in which they've creatively come up with to return your money to you.
Yes, insurance companies are creative in the ways that they will, I won't say take your money, but be willing to work with you.
Yes.
No, some of these are worth considering. And so I'm going to start with actually the one that I am probably uh, the biggest, if you could say, fan. I try to withhold my opinions on a lot of these, but the one that I would look at and say, okay, that's understandable. And that's a MYGA, a multi-year guaranteed annuity. And this is probably contrary to what a lot of people understand, but this in a lot of ways is similar to a CD. Okay. So CDs give you some fixed interest rate. A MYGA will give you some said fixed guaranteed interest rate, guaranteed by the insurance company. And the benefit here in comparison to a CD, this might be a 3 or 5 year term that you see with a multi-year guaranteed annuity, is you typically get a much better rate than the CD. The downside sometimes of this, it's not a steep surrender charge, but you will see often a steeper surrender charge or some type of charge if for whatever reason you have to withdraw all or some of the money, some of the monies before the term is complete. So multi-year guaranteed, again, I don't think a lot of people, I don't know about you and like how you've talked with clients, but I don't think a lot of people have that definition of annuity in mind when they think of it. They probably aren't thinking of CDs, right?
Mm-hmm.
But it is similar in a lot of ways, right?
Yeah, yeah. And that fixed income piece, I mean, especially with an insurance company, is something that is pretty unique in the way that they're able to offer them. Even during crisis modes, insurance companies have been known for being able to continue to pay what they had guaranteed as far as the rate goes.
Yes, yes, and they're different from banks,
Hmm.
actually in the way that they're set up, which is part of the reason why they're able to meet the obligations. Not all of them, right? But they're very conservative in the way that they invest. They actually have to remain typically more conservative in the way that they invest their monies, insurance companies, than a bank. So
Hmm.
it's not the same. And in a lot of times, during poor years, insurance companies, relative to the rest of the market, are doing quite well. Okay, so there's restrictions because they're insurance companies as to how they have to invest monies in their general account, which is why they can slap these guarantees onto their
Hmm.
products. Okay. So, second type of annuity is the income annuity. I would say this is the purest form of an annuity. We'll start with just a single premium annuity. Um, you give money to the insurance company. They then will give you a income stream for your life. Okay. That's going to be a percentage. So let's just say it's $100,000. Maybe for this example, you're 70 years old and maybe the percentage is 7.2%, you would get $7,200 per year for the rest of your life until you passed away. So you can quickly see, might be wondering, well, what happens if I die? Well, if you die, and in the purest form here, without any riders attached, without any other guarantees attached, um, you would lose in that equation, right?
Hmm.
What you're doing here is you're trying to hedge the risk of longevity if you live a long period of time. I will tell you that one of the ways to manage risk, financial planning stance, is just to die early. That is always one way to hedge it. Now, if you do live a long period of time, this is where the income annuity can be more attractive. Again, it's a set income that you get for the rest of your life in exchange for giving that lump sum. Okay.
Right, right. And again, with that, kind of the counter is that you do lose control of that money, right? You've
Right.
given it to the insurance company. They're going to dole it out to you a little bit at a time. But if you decide the next year, like, oh, I actually decided I want to use that money for a given thing, well, you're locked up.
Right.
So, but again, you have to look at it. Well, what am I trying to insure against, which is longevity in this case, and so that's
Yeah.
what it's for.
Yes. So there's the liquidity risk,
Yep.
which is, I think, um, for most folks, probably the biggest barrier to why they would consider this.
Mhm.
The idea of like handing over a lump sum to an insurance company. We typically don't want to do that, even if it's clearly stated, what income you might get, but you're buying a pension. That's what it is. An annuity is a pension in its purest form. So you're buying a privatized pension, if you will. Technically, there's no fees in the concept that maybe you might think. And again, the purest form here. the fees are more so baked into the calculation of the income that they're going to pay out to you, right? So you won't have like an annual fee that you have to pay or a percentage from that $7,200 example that you'd have to pay. Instead, the insurance company is simply just baking it into the equation as they're determining what percentage payout that you're going to get. And there's some different payout options that you have for really just about all of these. You can have the life option, which is just a single life option for yourself, a joint life option. If you're married, if you pass away, it gets attached to your spouse. You can have a life option with a cash refund, a period certain. There's several different options from a payout standpoint. I won't get into all of the different descriptions with each of those, but again, there's different payout options. Okay. Now, the second type of income annuity is the deferred annuity. So again, we have that immediate annuity. You say, hey, I'm going to walk up. Here's my money. I want to start taking income immediate. The second would be the deferred income annuity, as far as just income annuities for the second category. Okay. And that would be where you go to the insurance company and you say, hey, here's $100,000, for example. I want to start taking income at age 70. And these insurance companies will have step ups. So maybe at like 70, you get some bonus percentage. And so you want to wait until you get to age 70. And you're like, hey, interest rates are going up right now. Annuity rates are really good right now. So maybe I want to wait until, I want to buy it now, but I want to wait until age 70 to start taking income. So you can get a deferred income annuity, Valerie.
Mm-hmm. Yeah. And that'll, kind of attract people that are saying, this is part of my long-term financial plan. And one piece where I guess where I do like it, I don't really like the idea of putting all of somebody's wealth into an annuity. But, if you're saying, okay, this is my fixed income, this is my guaranteed safety net piece, and we can use that to kind of hedge or counter the part that we have as invested, maybe you're like, that's our equity piece that could be very volatile.
Yes. Again, and we'll get into some of the risks and some of the benefits of this, but you're already hitting on one, which is annuities. I guess if you were to compare them to stocks and bonds, we love to compare, which is difficult here because it is different. They're more bond-like than stock-like. That's probably the easiest way to put it. And so, if you do have some guaranteed annuity, it might allow you to be more aggressive with the rest of your holdings. Okay. And I think there's plenty of research to back that. Again, depends on your situation. Now, index annuities, third type of annuity here. We're firing it up. Index annuities are very different. Okay. You have a deferred account that earns interest each year based on a predefined crediting method that references some index. Okay. So this is different than variable. It might appear to be variable, but it's actually different, right? So you're going to have a few different, I would say, important caveats to this. One of those is the participation rate. So you get a 100% participation rate in the S&P 500, but you're maybe capped at 7 or 8%. So what that means is your money is not invested in the S&P 500. So you're not buying, let's say, some ETF from Vanguard. You will be credited as if that money was in the index. But again, that credit will likely be capped at some percent, 7 or 8%, let's just say, for example purposes. And you will have some participation rate. So if it's 100% participation rate, that means if the S&P 500 does 5% and you're capped at 8, well, you get 5%. The S&P 500 did 5. If it did 20%, the S&P 500 did 20%, you would be capped again at that 7% in this example, because you have 100% participation. If you had 50% participation, it'd be half of that, right?
Mike, and I think I'd like to, and just to add to that, I mean, the reason they're so attractive is that they'll also have that floor, right? And they'll say, we guarantee that you'll never lose. So you get the 0%,
Yes.
that if the S&P is down 30%, you don't lose anything. You're at 0%. But insurance companies are in the business to make money. And so they are honestly on the winning side of this, because when you're in an equity market, you are looking at years that there are 20, 30% gains. And that's really, there's just so much build up into that. And so if you're only capping off that 7% over the long term, in the insurance company, they're keeping everything else above that.
Yes.
And that is enough, more than enough, to offset those 30% negative years.
Right.
And so that's really where I encourage clients to look at it and not, what is it that we are sacrificing? We're sacrificing all of the upside in order to hedge ourselves against that downside. And what does that dollar for dollar look like over, let's use history for an example. And so that's kind of part of the analysis. And
Yes.
if you still are able to come out ahead for your financial plan, that just having a cap of 7% in the S&P makes sense, then it's probably worth it to feel comfortable that you're never going to lose.
Right. Right. Yes. There is the behavioral component here. And I think
Mhm.
that's a big reason why annuities continue to exist in the way that they do. We'll get into that
Absolutely.
more with the benefits. But yes, as far as now, what happens at the end of these contracts, this is always a question you should be asking. Um, you can choose to withdraw the account, roll it out to another annuity, or annuitize it for income. Okay. So this is again for indexed annuities. Moving on to variable annuities. I think this is this is our fourth type of annuity here. Okay. So again, annuity blanket statement, we're already pulling that apart. It's not just one type of product, but I would say variable annuities probably over the years have gained the most notoriety, right? They've been talked about the most. Probably good and bad. Certainly more bad in the variable annuity category. I don't see a lot of people slamming MYGAs, for example. There's not a lot of people out there that are just like slamming CD investments or short-term guaranteed investments.
Right.
Variable annuities, though, they've caught some flack, and I think part of that is if you think of what leads to bad investor decisions, it's really fear and greed. Like those are the two emotions that seem to lead to most poor financial decisions. And variable annuities, unfortunately, are often pitched as a way to circumvent both of those, right? Hey,
Mhm.
you can participate in all of this growth, but you still have all of this, guarantee or, downside protection, to use a couple words that are, beloved in the investment community. So, the question is, okay, well, what exactly are variable annuities? Well, that's somewhat difficult because they really can be different company to company, product to product, and also depending on what riders you have. So here's how they work in their most basic format. The money is actually invested. So this is where it's different. Okay. So the
Mhm.
money is actually invested in said funds. You'll be given a list of funds that you can invest in. You would invest that money. That money is invested in the actual funds. Okay. That means it can go up and it can go down. Okay. You can then choose to withdraw the account, roll it out to any other annuity, or annuitize it for income. So, in a lot of ways, similar to indexed annuities there. But this is where I think they get a little bit more complicated. The riders on variable annuities seem to be more prevalent. Okay. So, I seem to see most variable annuities have some type of a rider or several different riders that are attached to them
Mhm.
to make them more of a guaranteed product, right? So, like, you might see an inflation protector rider, or you might see which would protect, let's say, the contract value year by year, if it would match inflation. Or you might see a rider. These are less prevalent, I think, now, but you might see some type of rider that says guaranteed growth in income. So it guarantees you some simple interest rate, not compound interest rate on the contract value. So you might see that attached to the contract. Um, but you'll also see a wide range of surrender schedules on these. Okay. So some might have 10-year, 15-year surrender schedules. I think regulations have probably made that a little bit different in the last decade compared to like 30 years ago when these things weren't maybe the most attractive. Um, but again, point being here is the money is actually invested. You'll a lot of times see a lot of different riders attached to this vessel to make it seem more like an insurance product at the same time. But they can really vary annuity to annuity. Like it would do me no good to sit here and try to explain every single type of variable annuity because they really do range. What are your thoughts on
Right.
on variable annuities, Valerie?
Yeah.
It's a
Yeah.
difficult one to really summarize in an accurate way.
Yeah, I mean, I think that that's the insurance company's attempt to try and give as much flexibility to an investor to be able to take advantage of the market, of equity markets in particular, to be able to grow over time. But they try to offset it by allowing, there to be guarantees and hedges in there. But like as you said, I think the most important piece that we look at with annuities and any insurance product are what those internal fees are. You
Yes.
mentioned that you don't see the fees, you don't pay the fees; they're just baked in.
For the other
And
previous annuities, yes. For the previous
yeah,
one, for variable, they're more line itemed and you can look them up a little bit more clearly. Yes.
right. And so that's really going to be the most important piece is that we're looking at, well, what are the commissions that the insurance agent would collect? What are those administration fees that are locked up inside of there for for managing the annuity?
Yeah.
Surrender charges, like you said, if you have a 10-year surrender charge, maybe it's the first year. If you decide to take your money back out, you pay 10%. If you do it the second year, you're paying 9%, et cetera.
Right.
There's always going to be that mortality expense that that's just sort of part of calculating what rates the insurance company
M&E.
needs to pay. Yep,
Yeah.
yep,
Yep. The M&E
yeah, and et
fees,
cetera, et cetera. There's the riders themselves
rider
cost something.
costs,
Hmm.
contract values or contract fees. You'll see
Hmm.
that surrender charge schedules, again, more prevalent a lot of times on variable annuities. You have to
Yep.
lock the money up for longer. So I think it's really important that you do your due diligence on variable annuities. Um, Now, how are they taxed? This is where annuities, I think, especially variable annuities in the early days, but also today, I, agents will make a case for them in taxable accounts because it defers that taxation. So,
Hmm.
keyword, it defers the taxation. Now, when you go to take income from it, it is ordinary income on the growth. Okay. So that is an important distinguishing point in comparison to if you had the monies in a taxable account and it
Right.
was just invested in some investment portfolio, you would have long-term capital gains rates, not ordinary income rates on any growth that you would have if the investments were held there over a year. Okay. So that's an important piece. You also can't harvest losses
Hmm.
with and when we're talking about variable annuities here, you can do that with a taxable account. Um, Now, I would say another critical point and a question you should always ask is what happens when I die with this contract? So with a taxable account, you get a step up in basis. An annuity contract, well, it gets maybe a little bit more complex, right? So you
Right.
want to make sure you understand that. Um, Again, variable annuities, there's a lot that goes to this. The fees we talked about are certainly important. I also think, though, just in general, whenever you're evaluating some product, the question is like, what value do I get for those fees? Okay. So
Hmm.
if somebody said, hey, I'm going to charge you 10% for this product, and they somehow were able to guarantee me 25%, I would do that. Now that product
Right.
doesn't exist, right? But it's an example of how, we can sometimes maybe just be so concerned with the fees that we overlook the potential value of something. Still, just personally with variable annuities, I have seen less favorable contracts in that space than I have seen in the more immediate or MYGA space where it's just clearly stated, hey, this is what you get, and there's less maybe smoke to it, if you will.
Right.
Not to say everyone's doing that in the variable annuity space. I just personally, kind of come across contracts, and I'm sure you have as well, where you're like, okay, this just doesn't really seem like it was a good fit for the client, and the client has
Right.
no idea what it is.
Right.
Um, Risks of annuities. We're going to run through this real quick. Inflation risk potentially is a risk, especially for like a more guaranteed or MYGA annuity where you're going to be getting a lower interest rate, closer to a CD rate, better than a CD rate a lot of times, but inflation risk can be a risk that's definitely important to make sure you understand. You just might not get that much of a return because it's a guaranteed product. Surrender and liquidity issues, as we mentioned, so surrender schedules. Also, the money might be locked up. some risks of fixed annuities, potential legacy risk. Again, what happens when you die with the monies? Is there going to be a bunch of income taxes for the estate? Risk of variable annuities, I would say fees, definitely eating away at account performance. And also the risks we mentioned there. So surrender and liquidity issues with variable annuities. Now, the benefits, quick benefits here, it may allow for more aggressive allocation than your remaining investments, So if you do have, let's say, an immediate annuity, you're maybe replacing a chunk of what you would have put into bonds with something that's guaranteed and going to just pay out an income in a different way. So that can be a benefit. Also, less time and stress. So if you're, let's say, a retiree and you're like, I don't want to have to check my account statement every single day to figure out how much money I can take for this next year, and you're just worried about it, that's probably the crowd that annuities appeal to more than anything, right? My thoughts here again, variable. I've seen far more contracts in that space that I have been less of a fan of. Monies that were locked up, long surrender schedules, high fees. The client had no idea what it was, how to get the money out, when they were going to use it, and it just didn't do that well. Fixed annuities, though, I think are a great, maybe very low conservative, just alternative to CDs or to potentially bonds, even though they're not exactly like bonds, some way to get some guarantee into just your overall portfolio. So I can understand them there. I'm going to finish with just questions to ask. Okay. Some questions to take away if you are looking into annuities. What type of annuity is this? Just ask the insurance agent that. Why this insurance company and this product? There's a lot of different annuities out there. Why this insurance company and this product? You might find out that the insurance agent works for some captive company, and lo and behold, that's the insurance product that you're looking at. Why not just hold investments with this portion of my portfolio? Again, there's a reason to maybe consider an annuity. There's a reason to maybe consider investments for a portion of your portfolio. I would ask them that question. What are the fees? Always important. What are the guarantees? What happens when you die? How is this money taxed? Okay, that's definitely a big question to ask. Why buy an annuity in this account? I think a lot of times you see folks buying them in retirement accounts. I don't know if they make as much sense because, again, the benefit is that tax-deferred growth that you might get. So it kind of hurts when I see them in IRAs at times, at least certain types of contracts. What if I want to just get out of this contract? Another question asked. And finally, what is the participation rate? So this word guaranteed gets tossed around a lot. And if you dig into the insurance contract, you might find that the participation rate or the cap rate is not guaranteed. And that's how the insurance company is able to say, well, we have a guaranteed product. That's how they're able to fulfill saying that guarantee is, well, okay, if let's say the market, the interest rates just change and we have to drop the cap rate. Well, we as the insurance company can do that. And that is what they have done with index annuities. And participation rate, maybe they don't pay out the full 100%. Maybe it's a participation rate of 75%. So you only get 75% of the growth for that said index that year. So again, ask that question. That's like a little bit more in depth, but very important. Okay. So a lot we covered there, Valerie. I mentioned this is a complex episode to go through because there's so much to it and so many what ifs. But I guess what's your overall thoughts on annuities as we close out here?
Yeah, I would just say absolutely discuss with your advisor and see how they fit into your plan. There's not a blanket answer for everybody. There's a lot of emotion that goes into it, and just looking at what your overall picture looks like. So that's my final piece of advice before you decide yay or nay.
Dig deeper
with any product.
Yes, dig deeper. As always, if you're listening to this on YouTube, Apple, Spotify, wherever you might be listening, make sure to hit that subscribe button to get more industry insights from industry professionals here at Mariner Wealth Advisors. Again, my name is Michael MacKelvie. I was joined by Valerie Escobar, certified financial planner today. You guys take care.
Bye.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.